Want my latest market insights? My latest report, Recession Risk Just Got Pulled Forward Again, is now available. Click on the link in the description. Hey, greetings everyone. Thank you so much for joining us. Macro to Micro Options Power Hour. I'm Samantha LaDuc, founder of LaDucTrading, and this is Hans Albrecht, our options mentor extraordinaire. And we are basically coming here after a very busy Fed day. This is my third live appearance. Morning trading room, and then the Fed Day Live, and then of course our Wednesday special. So we can talk about all things FOMC. The market reaction typically has these kind of gyrations right before the announcement of rate cuts or not, the immediate reaction, then Powell, and then after Powell. So we got it all. We got something for everybody as far as the chasers in the room. Now, if you're trend or swing, you don't care so much, but we are going to talk about potential quant quake. Did you read my write-up that I just posted this morning, Hans, in our Slack member workspace? It might not have hit you just yet. Yeah, it says time to protect is now. So anyway, I know market is very happy with just a 25 basis point rate cut, but I did say yesterday and leading up to this for clients that 1 year ago, FOMC met and did a surprise 50 basis point rate cut. That was September 18th, 2024. That was very much a normative cut. They were responding after the August non-farm payrolls job growth revision of 818,000, and it made a lot of sense. We had a nice buffer, plus we had an election come up. So long story short, they did a normative cut, and I said if they do a cut today, it would be accommodative. Why? Because I've been writing about this recession risk pulled forward. And this has been a theme of mine. I've been very, very focused on employment underneath the surface. Over the past 2.5 years, there's been 2.5 million jobs revised lower. So it's not just last year and this year. You put it all together for 2.5 years, you actually have a very unstable, weakening labor market. And Powell pointed to that at his presser, saying we're more concerned about employment than we are inflation right now. He's still transitory man, but as it relates to tariffs, but prices are higher. Their estimate for GDP was contracting. Their employment was higher, up to 4.5% by end of year. And their PCE also, their preferred inflation gauge, rising. So that's stagflationary backdrop. And we want to talk about that because the market still, at least into today's print, was rolling these calls, the options market I'm referring to, was rolling these calls up and higher to 6650, 6700. My beloved 6666 for many, many moons. Now we're almost there, right? We came 60 points shy of it yesterday. So I think we're actually, maybe we hit it tomorrow. I don't even care. But I think the time to protect is absolutely now into the options expiration of this Friday and month end, when we start to see government shutdown risk pulled forward. And in fact, we'll talk about that, not to mention slowing growth. We'll talk about that, and rising jobless claims. We'll talk about that. All right, so that was it. It might look like nothing happened on the top line as it relates to the surface. It was pretty much where we ended, but underneath, we definitely have some cracks forming. So Hans, that's what I just kind of summarized breathlessly. What do you see?
Yeah, you're on the run today, Samantha.
I
yes,
am, totally.
I think, well, we got the usual, which was a whole bunch of sort of nothing from Powell. It was pretty funny when he sort of said, well, we just look through the front windshield. I said, no, you don't. You just look at your shoes the whole time. You don't look behind. You don't look in front. You have no clue what's going on. So now you're reacting with the rate cut. And you're right, absolutely. We're starting to see some of the panic. What did I say a month ago? What have I been saying all along? I said the options are too cheap. The longer term options especially are way too cheap. What are we starting to see now? That's starting to adjust. They're starting to pay up for those 6-month, 8-month, 12-month options. That upside call skew is starting to reflect a little bit of excitement. And that to me means there could be actually a little bit more, because as we sometimes talk about, you often sort of see that inverted skew, which we call it. I'll show you guys that chart again that I showed last week. I said, there is more room to go. I think I may have shown it a couple weeks ago. And I said, listen, this is showing you that there is room to go from an excitement standpoint. So when people start to get excited, they start buying those out of the money calls. They start covering shorts by buying calls, or they're just expressing their FOMO or their excitement about things to the upside. And upside often is very, very compressed. I had an argument with somebody last week on Twitter about, you got to be careful selling calls. They're always compressed. He said, you don't know what you're talking about. Immediately, I got the latest research from Nomura showing that call selling has been a horrific trade this year for the past year. Absolutely horrific. The upside is cheap, which you and I have been talking about for about 800 points now. So this is nothing new to the viewers of our show. So hopefully people have been taking advantage of that, because it has been an absolute smorgasbord of opportunity to the upside, because you have these resets happening very, very quickly. I know I was a little bearish on Google at one point, but I actually made a bunch of money because it reset so quickly from 180 to about 240, 250. I started getting out at 230 and pieced it out. The upside is not being captured properly. And I know that takes a bit of a leap of faith. Of course, these stocks have to go up, but that's what we do. We're looking at, well, what could happen and where are they potentially mispricing that? And I think there's maybe even more upside in certain names. Like I look at something like Micron, where it's trading way, way cheaper than some of the other semiconductor names. And it has that tailwind of memory, that side of things that's become very, very important. So I'm looking around and I'm seeing, okay, some of these things have adjusted lately. And now I'm starting to actually look at different kinds of strategies, at least in the shorter term, broken wing butterflies, which are long the upside, but also play for that potential higher level of vol. You can't get as aggressive when you have to pay a higher level of option pricing. So there's different kinds of things you do depending on the environment, but there's still opportunity out there, I think. And
are you also, one of the reasons why this calls are still cheap mantra is because realized volatility has been just coming down, 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 down. And here we are.
Exceptionally low. Yes, you're right.
Exceptionally low. So this is one of the reasons I didn't want to interrupt, but I wanted to show that chart because that's one of the reasons you have been continuously saying it's cheap. Calls are cheap. The upside is cheap, skew, etc.
Yeah, and that's definitely part of it. I mean, there is this realized vol. I think we hit a 4 on a shorter term measure, which you never see. I mean, it's exceptionally low. And as we know, we kind of been joking about that Sharpe ratio put selling strategy. We said, well, that's just kind of crazy. That's not going to last forever. Well, we did have a couple of days where somebody got run over. Somebody I knew got really run over, because all it takes is one day. When you're selling very, very cheap vol, that'll work as long as the market just keeps ticking up. As soon as you get that little 2% downturn in the market, you are going to get smoked. So there's always a risk in that. And that's why when you get vols that low, it gets me very uncomfortable. You just know that you're one corner away, turning the corner to a potentially difficult position. So there's no question, realizes is down, it's low. But having said that, we are seeing those implieds very low, and that upside tends to be compressed. So it's
you're also referring to the 5%. So this SPX at the money IV reading of just 5% represents extreme vol compression.
It is very low, but it's in a sense it's low. It's almost expensive versus what we've been experiencing. But yeah, definitely. I'd say sort of the shorter term option pricing is very low. It's maybe not low based on actual reality. When we look at actual volatility, we call that realized, we call that historical. It's been quite low as well. But it doesn't take much, especially into an event. I don't think it paid today because we kind of swung around, but that's pretty normal for a Fed day. We think things are going to go one way or another, and they often don't. It's the next day. It's the Thursday, Friday. We got to watch tomorrow and the next day for signs of an actual trend. Are we going to pull back? To me, it felt very much like maybe we've put a bit of a top into, basically somebody came out and said, well, they said 2 more cuts. And somebody said, well, what's one cut going to do? And he said, well, it's the trend. So he said, listen, there's a trend in place here. And so I think that at the very least has the potential to maybe put just a little bit of a lid on what's been working, which of course has been MAG, has been tech, has been AI. So maybe just a little bit of a rotation now. I don't know what you think, Samantha, into kind of maybe more real world stuff, more rate sensitive kinds of areas, real world touch and feel stuff. AI is not going away. In my roaring 20s scenario, which I've been talking about for a long time, it's not so much that one necessarily pulls back. It's they're playing sort of leapfrog, and one pauses and they keep going. And even the pause has been kind of wrong. Like I remember when we hit 6,000, I thought, okay, well, we're going to pause for a bit. Nope, we went to 6,250. And then I thought, well, we're going to pause a little. So I've never been bearish at any point along the way, but I did think we'd pause a little longer than we have at certain pit stops. And we really haven't. It's just been exceptionally strong based on the backs of, I think it really is kind of the same old story, which is excitement about AI.
All right. Well, just to comment on that, today's expectations, let me just show you this chart because it's hysterical to me. This little dot here, we got the SEP, so the dot plot. One of the members on the board, one guess who it is. Waller Bowman, but probably the new guy who just got approved on Monday night, Stephen Mirren,
He
who
tried
is
to vote twice. Right?
yeah, literally. He's White House counsel now sitting on the FOMC in Kugler's place. Anyway, the point I'm pointing out is that somebody expects cuts equal to 150 basis points lower this year. Now, the median cuts that the Fed basically pushed out were 2 this year and 1 in 2026. So it really was more of a hawkish bent, right? It was 25 basis points, not 50 basis points, which I contend would have triggered that they see recession risk is more imminent because of the employment picture. And he intonated and spoke directly about the weakening economic backdrop. So the other point I wanted to make wasn't just that somebody is very, very bearish. Otherwise, there was consensus on this 25 basis point cut is this lovely Fed speak for stagflation. So Powell was really clear in saying, all right, so we see a change in real GDP coming in that is contracting. We see unemployment rate, which is increasing. We see PC also strong. You can't see it because I got all these big arrows in front. But the point is, this is the opposite of what you really, really want to get to when it comes to a cutting regime. They are afraid of doing too much too soon. And of course, that is exactly what Trump, Bessent, Mirren want, which is this loose monetary policy. That same theme I've had for many, many months as one of the reasons for the seasons is that you have a backdrop of all gas, no brakes in fiscal spending. By the way, we might be hitting the brakes. There is a supposed vote this Friday for this continuing resolution, whether that will create the stopgap funding measure for the government for the 7 weeks, or maybe it doesn't go forward and we have shutdown risks pulled forward. The market's not pricing in. And remember, that is a contraction, that is an economic contraction trigger, and it would automatically trigger a growth scare. So that's something to be aware of. And then, of course, unemployment, jobless claims every Thursday. I'm very focused on that. We got the big revisions. They're worried about increase in employment rate, which is even harder, by the way, because we've had such immigration deportation hit that the slack is supposed to help keep the unemployment rate from increasing. And in fact, job openings are decreasing. The amount of jobless claims are increasing. And we haven't hit my trigger yet of 167,000, but that's another kind of crack in the system that I'm going to be looking for. And then prices, they are moving higher. Powell spoke to goods in particular, some services, disinflation. But the long and the short of it was that he didn't really know or didn't want to commit to tariffs being the reason that they would stick around, but he did see the increases this year and next. So he spoke on behalf of FOMC board of saying basically the risks right now of rising unemployment and rising inflation are the reason why they're tepid in their response. They are reactive, not proactive, but I think they thread the needle. They don't come off as fiscal dominance, bowing down to the will of POTUS, but they also don't want to scare the market with a 50 basis point rate cut, which would absolutely send signals to corporations that, careful, disposable income is going to start to take a hit with it spending. And now we need to kind of maybe do some restructuring that creates more layoffs, that contributes to joblessness. So that labor shedding factor is what they're trying to limit. But I would absolutely contend that this cut was not normative. It was accommodative because of the employment backdrop.
They're going to be between a rock and a hard place, I think, at some point. And I've been calling I think AI is very deflationary. I think we're seeing deflation in services. I think the economy is largely service-based. I think we have to recognize this isn't the 1970s anymore. And we do have some goods inflation, but there are going to be large areas of the economy that are going to be under pressure from a pricing standpoint. And certainly one of those is going to be wages. I mean, outside of the people getting hired for $100 million, unless you're really one of those superstars of AI, there are going to be a lot of areas of the economy that are going to have that pressure from a wage perspective. So, but I do think there's more strength. You can just see it. There's strength in the economy. Unemployment is quite low, let's face it. And you do have fantastic margins. I mean, if you look at some inflation swaps, this is not really stagflationary. Maybe at some point we start to see something like that. But I think in this AI period, you have to kind of zoom out a bit.
The
Sorry.
Fed is saying it's stagflationary. I'm
Yeah.
saying it's stagflationary.
Yeah. I don't,
So,
I don't,
I'm in agreement with them.
yeah, I don't agree with them. And I think the economy keeps proving them wrong. And we'll see how that goes. I think it was Goldman that came out this week. They said they're not even calculating GDP right anymore. They're not even the inputs into AI. You talk about chips and servers and semiconductors. I can't remember how they do it, but they're not captured as a kind of output increase. So, and then productivity gains, which are starting to happen. A smart guy was talking about it today on CNBC. Says they're not even measuring productivity. It's starting to happen. And this is pitch one of the first inning of how the
we can't even discuss, because this is something that not in the dot-com era had any positive print for productivity.
This is
It's not
a
worth it.
1,000 times bigger, 1,000,
Okay,
10,000
so I
times bigger.
know you are consensus bull. I got that. But you also
No, I know, but look, the economy is doing fine. All these calls for the economy to fall off a cliff, it's not happening.
No. Who's calling for the economy to fall off a cliff?
Well, a lot of people are saying, well, there's a recession right around the corner. I mean, it's just
okay. So there is some data to support that. 2.5 million jobs that have been revised lower over the 2.5 years would indicate that the employment situation is not as rosy. We've got lots of data to back that up. I write about that every week. We also have real GDP, which is falling. Now, I know you're countering that. And by the way, I mean, GDP is falling as an example. If you do real GDP, not the nominal, I will show you, and it's getting a little iffy here. So this is one of my posts that I posted recently, hell-bent on SPX 6666. So of course, this stuff takes a while, and we're looking at data when it comes in, employment reports, JOLTS. But St. Louis GDP is right here, and this is important. This has been falling. Have we fallen into negative territory? And we need 2 quarters for recessionary confirmation. But by then, the market's already going to price it in. So the point is, this stuff happens slowly, then all at once. And in 2007, jobless claims started moving higher in a year in advance, like June 2007 type of thing. And the market didn't roll over into a 55% collapse until October of 2008. So my point is, it isn't falling off a cliff. That's not how it works. Housing tops and rolls over, and then it picks up speed. Employment tops and rolls over. The market tops and rolls over. So we're in this process right now of waging the economic data, which is weakening, and the Fed is highlighting the weakening employment, the rising inflation, the weakening backdrop here of housing. All of this stuff I agree with, because I've been writing about it, literally saying it's going to come to a head at the end of 2025. Now, I know you want the AI backdrop to have time to work its way into the system, and
it should. Yeah, we don't know how fast. Yeah, we don't know.
NVIDIA is getting
fast.
kicked out of China. I've been warning about that for months. Small companies are going from zero to hero overnight because they are effectively monetizing their AI. So we're going to have pockets of small companies that thrive, and of course the big company moats that absolutely drive. But it does not mean the economy is doing out. The real economy is actually very bifurcated, and it will become an issue into 2026. So we can trade what we've got, which is of course momentum. You know how bullish I have been on the China sector rotation. It's hot fire flames. We're in a parabola. It's stunning. Gold and silver, stunning. And those are not the AI. So there's always a bull market somewhere. And you're trading very hot and heavy the AI narratives, anything it touches. So there are lots of ways to make money. The trick is not to lose it. And my point in my recent post, after looking at Monday and then getting, something's happening with FX currency risk, something's building, didn't see any rate volatility. I've got my lines in the sand I'm waiting for. Didn't see any equity volatility, no selling, no breadth destruction. But I got a lot of tools to see when the market starts to realize some risk that's coming forward, and they can then start to sell, and then everybody catches up to that narrative later. And so I posted this morning, it's time to protect into end of month. You know this, I haven't said this. I've seen nothing. We just keep grinding higher into 6666. I don't want to wait until 6666. But the point is, we could very easily, like I said, with the structures right now of options, they have just been plowing higher into that 6650, 7000. That's kind of your call wall, and your 6500 is kind of your put wall. And that's kind of where we're going to play, 200-point range. I think you'd agree with that. And you're waiting for the next momentum trigger. And hopefully we just get a reversion to the mean before it gets bid back up into year end. I'm talking about
I agree with that.
Reversion mean into the end of the month, where we then get to see whether or not or how strong corporate bond issuance is, and if they've kicked the can down the road with a 7-week CR vote to fund the government. I'm looking at all the macro risks that are coming in, but you cannot tell me that the economy is not weakening, because I study this very, very closely. So the market is not weakening, but the economy is.
Well, the statistics that they look at normally, yes, that's right. But as Goldman says, they're under the real contribution is probably 4 times as much due to the things that they're not calculating correctly. I agree with you. I'm not saying this time it's different, because I've been around long enough to know that that's a very dangerous saying. But this is a very different time. We can't really compare this to the 90s, the dot-com directly, and some other periods. AI just kind of changes everything. So we're going to sort of see, we'll see how much the infrastructure push kind of plays its way into the economy as well. And you can see in industrials, you can see power generation. You can't even get the power generators you need anymore. There's such a push into that sort of physical world of AI to get this built. That's going to be quite a push for a little while. So there may be a shift, and I agree with you. That's the reality of it. It's going to be a very disruptive kind of environment where there are going to be swaths of employment, areas of employment that are going to be affected. And hopefully the economy is good at sort of redeploying those kinds of things. I have my doubts that's going to be as easy as people think.
I have a great podcast for you to listen to. Juliette Declercq. She is a French macro wonk. I love her. And in fact, I discovered her early. She worked for Paul Tudor Jones, and then she was on a Real Vision 1-hour special, and everybody else was a man. I just happened to see her. She didn't have any titles. Wasn't known. This was years ago. And oh my God, she had the best charts and she had the best arguments. I have followed her very, very closely since and listened to everything she does publicly, because she has a $10,000 a month subscription for institutions. Ooh. Yeah, she's awesome. She's worth it. She's definitely worth it. Anyway, she's like, no, AI unemployment is going to be a massive shift. So anyway, I'm not, I don't play in that wheelhouse of crystal ball there, 2 years, 5 years. I'm so looking at just where the market is in the next quarter, and what sector rotations are ready to trigger, and if they are still durable or not, and then stock picks based on those 2 things that I just figured out, right?
Right. And we're traders too. And yes, I agree with you. Yes. I think some things are a little overextended.
You can't price in that AI unemployment to this market right now.
Yeah. And it's always hard for me, because the certain things, and I've learned to do this over the years, whereas in my earlier days, I was doing literally 150, 200 trades a day as a market maker. And you're not necessarily paying attention to the forest. You're kind of in the trees. You're in the trenches, just kind of doing things. So as I moved over to the investment side, it was kind of bringing some of that sensibility of the little small details and nuances, but in looking at the bigger picture. So there's always going to be a little bit of that trader in me, as well as the bigger picture. And so I find that those are kind of valuable things to have. And I know you do that too, Samantha, where you're kind of different, zooming in and out and looking at the different time frames. And I think that's a very powerful thing to be able to do, because the larger time frame, believe it or not, can actually inform your much shorter time frames, because it can give you confidence when something is happening within a given day. You can be infused with confidence by your larger idea of a theme or something that's unfolding. And trading is about confidence. And so there's no question, I think, if I put my trader's hat on, boy, I look in at some things like like Broadcom. That thing has a long way to fall to get back to a reversion of the mean kind of thing, if you want to start looking at fundamentals. Obviously, in this kind of environment, we are starting to approach an area which I'm familiar with, just because I did go through .com, where fundamentals kind of go out the window, and it just primarily becomes more about story. We'll see how this plays out, but there was I'll try to find the chart here, where it shows that the sort of percentage of the S&P that actually starts to have that inverted call skew, which means that those upside calls. We were talking about it on Twitter, Samantha, this week, where somebody had mentioned it, and I said, oh yeah, we were kind of discussing that on our show, where we could starting to see that level of excitement. So it's always going to be, we always have to kind of look at that and go, well, are we early in that excitement? Are we 3rd inning, 4th inning, 5th inning? Are we 8th inning? Are we 9th inning of that excitement? And then that's where, as a trader, you're going to say, oh boy, that 9th inning of that level of excitement, we're due for a 200 or 300 point sell-off. So we probably are at this point. I kind of thought maybe the FOMC is a signpost. Sometimes you just need the signpost up ahead, like Rod Serling. There's a signpost up ahead, and that just might mean we have an excuse to sell some on names that we're up a whole bunch of money on. And maybe that I feel like this is going to be a little bit of a rotation at this point. We might see a little strength in the other world, that other world of 490 stocks that
we'll see. Typically, I have a mantra. In lieu of sector rotation, there will be volatility. So expecting growth to roll into value means you really, really, really need to know which value is going to get supported. So this right now is a growth pullback is pretty much in the cards right now, unless we're going to surprisingly ricochet rabbit higher. But I don't think we are until the end of the month. So let's just see what happens. But for right now, I'm in protect now, end of month. One of the reasons we've got about $1.1 trillion in notional value expiring on Friday. That's a lot. So that's an opportunity for bears to basically come out at least and get something to eat before they go back into hibernation. Another thing you kind of reminded me is when we're talking about things that are really, really going quickly, like a 1999, I don't think the market is in 1999 mode at all. I mentioned that back in November of 2023. What I think is in a parabola, and literally I said after the Fed pause and Yellen Yahtzee of November 1st, that set free this, they're going to pause. Yay. Anyway, we doubled in massive order 2023, 2024. But the point is, it was pretty controllable. We didn't go straight up like right now China is. And this is literally, remember July 11th, I did my post and I said China's ready to do this parabola. And this is exactly what has been going on. So as much as the market has been grinding higher, this is when I did my post. We had to wait a little bit, but July.
Is Jeffrey still big on China, Samantha? Is he still all in? Yeah.
Well, no, he's not all in. He took some off and he does not time it technically. So he is definitely reduced in his China trades. I think there's, again, a trend long here. This is a parabola. It takes a while. They're doing stimulus. Folks think that China's going to do a devaluation. No, because that would negate the effect of their stimulus. They're doing more stimulus than great financial crisis. So this is very, very advantageous. Plus, they're saying get out NVIDIA, and they're telling their tech companies to buy their own country AI chips and ecosystem products. Baba has it. Baidu as well. Look at Baidu. I mean, this has been gorgeous. So clients know how bullish I have been on this stuff. It's not even funny. Anyway, July 11th is when I said it's getting time also for gold to push higher. And this is exactly what we had with gold. So same time frame, boom, silver too. Although silver is coming back a little bit, doesn't like volatility, and miners are coming back a little bit, doesn't like volatility. But as it relates to the market, we don't really have, this is a grind higher. It's quite orderly. It hit perfect support level, got the intervention on April 9th. I warned of a May 12th gap up, which is exactly what happened because it's May 12th birthday rally. Then we had the June 23rd Iran-Israel de-escalation. All along the way, we have had mechanical buying, corporate buybacks. We have corporate buybacks that are in blackout, but they only provide 1.5 billion a day. That started on Monday. That'll run until about October 2nd. But we have some other considerations, which is CTA is about ready to look very seriously at these negative gamma prints. And if we do get and stay below 6,500, then I believe we're going to start to see this, which is big tech, big rebalancing. So it isn't just, okay, let's look at this growth scare that's coming in from an economic standpoint, but also from a quant standpoint and from my intermarket growth value rotation standpoint. Does that mean I want to buy small caps? You first. I do not.
Yeah. I mean, look, everyone's excited about it because this is the moment they've been waiting for after so very long, that rates are going to come down and 40% of them don't make money. And these are the people who employ a good chunk of the economy. And so that's a little bit more fuel for some optimism that we're finally getting those rate cuts that could potentially, although as I've kind of joked about before, it's probably just you make it easier for companies to borrow money. They're probably just going to spend it on things that actually are negative for employment. Yeah. Buybacks or they're going to invest in AI that actually ends up getting rid of people in the long run anyway. So I don't know I'm not sure how that's really going to help.
It's always about the financialization, unfortunately, for Wall Street, which is what makes the market go up and why Trump wants to be a hero and all the tax receipts that they get, yada, yada. But for right now, I think there is reason to take care into end of month, and I'll revisit it at the end of the month. AI employment isn't going to have an impact. It's going to be the old-fashioned jobless claims numbers and real GDP prints and headline risk of shutdown. Good old-fashioned macro event risk, which is front and center, is what I am thinking about, even though the option market is not pricing it in. And by the way, you know me, if I don't see breadth deterioration and selling underneath the surface, I can't be bearish technically, but I'm bearish and I don't see the selling yet.
Yeah. Tops kind of form over time. At some point, we'll get a 2% sell-off, and then we'll kind of surprisingly, we'll rally almost right back to the highs again. And so we'll kind of start building that top, unless there's something particularly negative that just pulls us back. That could always happen as well. But I think people are in the camp of, well, let's stay long until something changes our mind.
Oh, no, this is true. I mean, some people, like you said, you help folks, not just at LaDucTrading, but I mean, in your courses as well. If they're long and they want to protect for whatever reason, you don't have to exit out and go to cash. That's for trading portfolios. Okay, maybe. But no, there are ways to protect. And in fact, here are some folks asking questions in chat. Let's go through those because they're definitely related to stuff that you were talking about with call the upside is still cheap. And it is still cheap.
And I did see that somebody mentioned sell calls. Well, we are starting to see a little bit of that tail kind of wagging to the upside there. So it's not as cheap as it was. But so I think in some shorter term positions, for the first time in quite a long time, I could feel like, okay, I could be compelled to maybe sell some calls in here. I did on a few different positions. I tend to do that sparingly just because if we're in breakout mode, I don't really want to get in the way. But there are times where you kind of get to a spot where you feel like, okay, and like I said, this is the signpost. Maybe we kind of muddle about for a little bit here until we sort of sort things out. As this rotation happens, sometimes you're just going to get a whole lot of nothing happening from an index level, even though below the surface, there's a little bit of moving about. And so that's a chance for you to maybe kind of lock in some of those gains if you don't want to sell out of your positions. And then downside skew, it has come in a little bit. And what I mean by that is those out of the money puts, shorter term, coming down a little bit in the S&P complex, but still, they still price very well. So I put on I was worried a little while ago on NVIDIA. And I agree. I think Google, TPUs, you've got a few, Amazon, you've got Meta, although I don't think they make those available commercially, but there are many efforts out there to kind of create their own chips and more energy efficient chips and things like that. So they're going to have a bit of their work cut out for them at some point, as these companies don't want to outsource to all these expensive NVIDIA chips forever. So that could be a bit of a problem. So I've had some put spreads in NVIDIA, which are kicking in this week.
Anything I have below 173. That's my line in the sand, and it works great. It's going to we pierced that 171 and then 165 because we did that exactly the first time. And the first time it bounces at 165 post earnings. We did all this live. Second time it's going to break. And the second time it breaks, it's going to go down to 152. So that's my swing duration time frame. We've talked about this. So to me, those puts, depending on if you have time into end of year or put spreads, they make sense to me. I don't think they're expensive. I prefer that over selling calls. And the same thing with SPY. I don't think SPY is expensive or the NASDAQ is expensive to get directional puts or put spreads, depending on your time frame.
No, not expensive at all.
I don't mean a Friday, September 19th. I'm talking end of month, middle of
not
October.
Zero-DTE. Don't trade the Zero-DTEs.
Not my game. You know that. What about long vol calls? I find them to be expensive, but
they're inching up. So I'm looking at Tesla, which that's unique because it's starting to go a bit, potentially represent a bit of a parabola if things get going with robo-taxi. We always put on a few positions today. I've had a strangle for a little while, sold out some stock and some long calls, and kind of reconsidered the last couple of days because we could be approaching, Tesla's kind of that moonshot factory that Google maybe used to be considered, and their power business is underrepresented, under sort of rated. So there's some interesting things there. It's a stupidly expensive stock, but if you start to look at where they could be, and this is about stories, right? If we are in a mania type market, it's going to be about stories, and Elon is going to benefit from that. But there's some other ones where I'm looking at NVIDIA, still not expensive. So if I look at 6-month option pricing, really not expensive very much at all. It's kind of inched up just a little bit. Amazon, a little bit more. If you look at 1 month or 2 month, you've got to sort of incorporate earnings into that. So they may not kind of give you what you want. So if I look at 6-month options on Amazon right now, have really bounced back from around 28 all the way to 31 or so. Now that doesn't sound like much, but for a 6-month option, that's a fair bit. So I was looking at some Teslas today and looking at potentially long-term plays. And one play was going to cost about 88,000 to put on. And with the jump in volatility that we've seen in those contracts, you could very easily give up about $3,000 if that volatility compresses a bit. That's your Vega exposure. That's not theta. Theta is that daily kind of erosion that happens through time. But when options get a little bit more expensive, if they want to reset, if the market just kind of goes quiet and they decide, well, Teslas should be at $400 for a while, then that will compress. You always have to think of, that's why I like to look at those volatility charts, because it's not that I don't necessarily want to buy something that's expensive. It's that I want to have in mind, well, what's my downside if I'm wrong, not just on direction, but if I'm wrong on perhaps things going a little bit quiet. That's always a real reality with options, because as we know, they are an instrument with a limited lifespan. So you have multi-dimensional risks that you have to keep in mind. But having said that, I don't think they're crazy expensive. But as we've often talked about, Samantha, they're starting to kind of price in, are we about to melt up even more on whatever, AI or whatever, flows, sentiment? Looking at some sentiment indicators this week, people are still not that bulled up. I know the market is bulled up, but if you look out there, people aren't super bulled up from some perspectives. And anecdotally, from people that I talk to all the time, very hesitant. People have been having trouble going long for the last 400 or 500 points. It's hard. Everyone's like, is this the top? Is this the top? Then we move up another 100 points. Is this the top?
Well, I don't know about any of that. I mean, the sentiment or anecdotes, I honestly just study my very diverse system of looking at macro and quant and intermarket and technical and fundamental and a little bit of sentiment. But what drives me in this particular case is that I look for triggers that could create the selling, and then the CTAs that pile on that are just waiting. They're not buying anymore. They're fully satiated. They are just waiting for those negative gamma prints in order to sell aggressively. And the dealers just pile on and the fall funds just pile on. And we could be very quickly looking at a fast VIX move that reprices everything. So, and anybody who knows me, and like I'm looking, I can stalk macro bearish every day, but not tactically bearish. So for me to put out a warning, it's time to protect now. It is not just end of month, Rish, because you're asking how do you reconcile the short term end of month caution. For me, it's definitely protect in the short term, like I did this morning pre-market and gave the levels, and we happened to hit 3 of them. I'll show you in a second. Anyway, the point is, but it's also end of year. So if you read my piece yesterday that was quite long, a very large bet came in, and this is in the SOFR market, which is very complicated, but it's institutional, that is betting on weakness into end of year. And it's not a little bit of weakness. It's recession weakness. So I have been beating the drum that yes, the top line looks fine. Even my breadth underneath selling looks fine. But when I start to see huge institutional bets that are probably hedges, right? Then I start to say, end of year is also a risk, not just the next 2 weeks. So what happens if we do have that nice little pullback post Friday, September 19th, and then it doesn't bounce?
Well, then that's
you got some skin in the game. You don't
Yeah.
have to take those off. They're already going to be expensive, but you don't have to buy expensive then.
But that's the gift. That's the low vol is the gift that keeps on giving. I don't know, maybe not that good, but it's a gift for us because you see that volatility. I saw the beta of the VIX to the S&P. It is absolutely in the basement. We've been talking about that since last year, and there have been times where the VIX is like a frightened cat in a room full of rocking chairs. It is literally it's moving on literally anything, on any pullback. It doesn't care at this point. So you're right. Bond vol doesn't care. VIX doesn't care. VIX futures, nothing really cares. We have one of the steepest contangos that we've seen in a very long time. There is not a care in the world out there. There's not a belief in the world that we're going down. Now, people buying out of the money hedges, sometimes that just enables them to stay long. So sometimes it's hard to kind of read into that too much. But we know that the hedge funds, from some of the things that I'm reading, hedge funds are super short VIX. And that upside is indeed what you're talking about, Samantha, which is this potential powder keg. If it's not going to be on a 0.5% sell-off is in this kind of environment is going to be bought up. A 1%, probably not too bad. A 2.5-3% sell-off could very well turn into a 5 to 7% sell-off. That is kind of the world we're in, very much volatility clustering. So it's very much that the market is well bid, even on little sell-offs. But you're right. If it starts to get going with this extreme short positions, it's a very crowded trade right now that people are playing. there is this asymmetric risk that if a shock of some sort emerges, it could start to unravel the other way. And we won't recognize that because we'll say, wow, we just came through months and months of not a worry in the world. And suddenly everyone's panicking. And that's the reality of CTA vol targeting you were talking about.
Yeah.
Absolutely bulled up. They're absolutely
So that's why I'm cautioning now, is because I have watched the CTAs and I have written about the CTAs all the way up, all these different mechanical buyers across the board. There's like 5 categories and I write about them, and now they're not doing much. So we're still grinding up on the wall of worry that you write about, but this is different. So when we get selling and we trigger negative gamma, the likelihood of selling begets selling by these CTAs is enhanced. So what I'm saying is, even though I've had 6666 as a price target for many, many moons, I don't know if we're going to get there, but I don't want to wait 60 points. I want to warn clients now of what I see. And so case in point, this is what I showed this morning. As an example, you can see that this is yesterday, 9/16. So I went over this with clients going, okay, I can see this weakening and coming back down into this area. And I'm just going to show you SPY because this is a 2-hour, okay, dollars falling. I wrote about that. Yes, gold has been in a very solid uptrend for all kinds of reasons. But more specifically, yesterday, as I did my live trading room, I'm like, okay, we're at 591 for Qs and we're at 660 and change for SPY. This is where I see you need to protect. And so what we get today, I can absolutely show, and this was the 10-year, by the way, after the rate cut with the expected 25 basis points, it would not surprise me if yields move higher. And here's that little inverse head and shoulders that I annotated, and we need to get above 4.09. My line in the sand is once we get above 4.1%, and I've talked about this rising yields, this is what equities have to worry about. So this is what we did today. This is live right here. This is FOMC. We did roll over on Q, and we tagged my 585 area for the Qs and then bounced right back up to 590. So if you were looking from yesterday to today and didn't know what happened underneath the surface, you'd say nothing happened. But that's a lot of volatility that's coming in. And then the same thing of my 3 price targets were hit. SPY came all the way down to 655, let's call it. So the point is, we've already come in to play. I mean, really, the market participants have already been wiped out of their near duration calls after this drama. So we've already come down into this level. And which level? Right here. So I can still see lower levels. I don't think that's a hardship at all. So it's just protect directionally. That's short duration. Oh, and by the way, the 10-year, take a look at that puppy. What happened with dollar and yields today? Alley-oop.
And the dollar.
Boom.
The poor dollar.
And here's,
yes.
Yeah, look at this. Boom. So that's right on cue. So that's what I mean by, okay, now the equity market is getting a little bit underneath the surface. It's starting to recognize, also dollar yen had a big move, FX volatility. We saw VVIX move up on Monday, and I made note of it to clients. VIX and VVIX were green. The market was green. It's always a precursor that the market's getting a little nervous. So do we have a vol event right now from FOMC? No. But we do have a big amount of SPX gamma coming off the board on Friday. We do have shutdown risk. We do have a weakening economy and weakening in labor market. That matters. Eventually, it will either reprice or there'll be some new narrative that gives momentum to the market higher. But I don't see what that's going to be. I think Q2 earnings were as good as they get. My warning has been be careful. Q3 is coming in. It probably is tepid. And then Q4, the rubber meets the road. So all of this is, it takes time to realize from the fundamental standpoint. It also took time for the market to realize, hey, wait a minute. NVIDIA is not wanted in China? What? Now, will they still do the backdoor in Malaysia, Indonesia, chip sales? Of course, they're going to continue to bypass sanctions and bypass Chinese officials, but that was coming. That's not priced in. That Chinese growth is just poof, gone away. But is any of the market pricing this into their models of NVIDIA? No, they're still excited about robotics. They're still excited about AI. The story will go and go and go until one big player starts to unravel and then the rest will follow. And the whole thing, unfortunately, is unwieldy. So that's the risk, but that's a later risk. Right now, I'm just looking for 2 weeks and end of year.
And somebody is asking, VIX has been up a little bit. Yeah, the VIX has been up a little bit. We have seen a little bit of that spot up, a vol up dynamic, which means market up and VIX up. Well, that makes a little bit of sense into FOMC, although I don't think there was really any big mystery. I think everybody knew that it was going to be a quarter. They kind of kicked it right down the middle in a sense. 2 more rate cuts. I don't know what people were expecting there, but that shows that there's going to be a trend in place.
They were seeing more. So they were seeing more for year end, at least 3. They were seeing more for next year. And the median, of course, these are penciled in. That dot plot that I showed you, the one outlier that expects 150 basis points for this year, I mean, that's fiscal dominance or that's hard landing. But the point is, right now, the market got what it wants. At least it got a cut. And now they're going to expect one at the next FOMC meeting and the next one after that. The problem is, it is a stagflationary backdrop and they can't fix it with their cuts. It's done. So this to me is fait accompli, that the economy will weaken and eventually equities will get repriced. Probably not until end of year or next year. But if you have a solid fundamental or macro trigger to keep the game going, like policy intervention, QE, then just remember that QE is going to be very inflationary. And rate cuts are going to be inflationary. So unless the economy can grow, we can't outrun it.
Yeah. And that's the
tricky
hope.
thing to, that's tricky. And we have no labor cushion now. No more labor cushion. We had it last year. It was disguised. And now this year it's not. And now they want to hide the data. Trump has a new BLS director who may not even allow the monthly reports. And we have now touting all kinds of nonsense about semi-annual corporate reports and earnings, which is just a boon for insider trading and grift. But the point is, we're going to be in la-la land, but that's very different from an economically strong point. Yes, the companies are crushing it. I get this. But is it going to be enough to really make up for the regressive tax that is inflation from tariffs and everything else on Main Street? So Main Street now actually does matter, and it has not mattered.
Yeah, it has not. The market may continue to think, I mean, as we've been saying, like there could be just a wider gap distance between Main Street and Wall Street. Companies are killing it. I mean, at some point, the reality of jobs has to set in and difficulties have to set in, but there's no question. Maybe the government should take...
Which companies are killing it, though? Which companies are killing it?
Well, profit margins, it was a pretty good earnings season. And now
only for the magnificent ones, the ones that are absolutely just chugging along and honestly do not have the same girth. They are not providing the revenue growth. It is all from the AI ecosystem.
And it's full speed ahead. I mean, we saw from Oracle, that was absolutely off the charts. I mean, I know it's one client and I know OpenAI, I don't know where they're going to find the money for that. But anyway, I think there have been signs that this is absolutely not waning anytime soon. But we'll have to see. I mean, I thought it was interesting. We've seen financials do well. We've seen some other areas do well. And I think they're going to probably do well with AI and productivity and all that stuff. I mean, financials are the ones that kind of figure that stuff out quickly because they're rather ruthless and they don't really do anything except push pages around a table. So they'll be able to figure out how to juice those profit margins. So I think there is the potential for this kind of divergence between, jobs are softening, but profit margins are improving. So we may sort of see this kind of confusing situation, which that's the kind of thing that may not necessarily fit into the sort of traditional economic way of looking at things and measures that we look at. It's going to be very, very confusing. Just like, well, the economy seems to be doing relatively okay, despite many things. So we'll see how it plays out. But definitely. I have been adding puts though. So I added some SPY 570 puts a couple of days ago. So absolutely. And I said this a month ago, maybe 6 weeks ago, I said, listen, when this melt up starts, I'm going to be playing it one way because the way that I see it, either something breaks and the S&P's 4,000, or this is just Shangri-La roaring 20s all over again. And we go to 10,000 because there's nothing better has ever happened in the history of the world with this AI stuff and everybody wins. And it's like a life of abundance. The guy says he's a billionaire. He's like, it's going to be a life of abundance. Yeah. Everybody living on universal basic income. Yeah. It's going to be a world of abundance. He says, you're going to be able to just have fun and do all your hobbies and all that stuff. Well, okay, maybe you are, but there are going to be challenges for a lot of regular people. So we'll see how that plays out.
Well, this is basically Goldman as well. So 109 AI stocks in the Goldman Sachs AI basket are now valued at 29.2 trillion. That is nearly equal to the annual US economic output. So we're talking market cap. We're talking about future expectation of earnings that may or may not happen. Now,
we are pulling some forward. There's no question.
Yes.
Pulling some forward. Yeah.
just a bit.
There's some
So
being pulled forward.
this is why I called it the everything AI tech bubble. Now, that doesn't mean it's going to pop. It took a year for Oracle back in 1999 to 2001 kind of time frame. It was right at the end and right at the beginning, right? For it to actually roll over. So this is what I'm saying is this is just, for me, we can still move higher. We could take the top 10 mag 10, okay, whatever, and compare it to .com, and there's still room to go higher. So there's all kinds of ways to distort and contort the data to show passive income is still relatively strong. Margin debt is still rising, not rolling over. Tell me when it starts to roll over, because that is your absolute telltale sign that we're ready to tank. So the point is, there are lots of indicators that still say the market is fine. I'm talking the economy. So my focus is on the economy relative to the market. And
the thing about that is these are not expensive stocks. Look at Meta, look at Google. These are not, given some of the growth that we're seeing and given that there are signs out there that this continues, I don't see why MAG necessarily gives up the lead for too long, just because that's where the money's being made. But it's also where a lot of people are being let go. There's another company the other day, I can't remember which one it was, and they said, yeah, we're going full AI. We're getting rid of a couple hundred people, 250 people, and I think they have 700 total. And this is the way things are going to go. It's going to be, we're going to juice our profit margins. We're going to do everything we do now with about a third of the people we used to employ. And so the question is always going to be, well, do those people redeploy somewhere else in the economy? Is it the age of abundance? Does that mean that those people can now go and invent apps with merely the thought of a new app with all these new technologies? They're certainly not going to go drive Uber, because nobody's going to be driving those anymore. They're not going to be working in fast food restaurants, because those are going to be converted to robotics as well. So we're going to have to pull a bit of a rabbit out of a hat, or a few rabbits out of a hat at some point, in terms of the way employment gets redeployed across the spectrum. And that's why I'm kind of B to the wall. Let's play this, because I've seen this before and it's exciting and I love being a part of it. I want the mania to continue. But at the same time, when you're given an opportunity to hedge, just consider that money that's gone, but it's there just in case. So I've been adding some, and again, downside put spreads in the QQQ, in the SPY. You don't have to get complicated here. You can go look in like HYG protection is cheaper, because I'll give you all the nuances of volatility and that. You don't have to get that complicated. There's very, very simple ways to create some downside. And you can finance it in a way. You buy a 600 put on the SPY and finance it by selling a 500 or a 520. You're getting all that juicy downside expensive skew that's financing that. Now, you're not protected down to 300, but we're making the assumption that the world's not going to end. And there are very inexpensive ways to create hedges that can help you stay the course. Because a lot of the time, unfortunately, Samantha, I see people who are like, I just can't get back in. I have a couple of clients like that. I just can't pull the trigger, and they've been out of the market for so long. Well, just get in and protect. And that's one way to kind of approach it, or move into calls, which a lot of people have been doing, I think, long-term calls, and putting a lot less at risk. So
and watch the dollar and watch yields, because the falling dollar has really masked a lot of this advance, not just because it's a tailwind for companies that derive revenue abroad, that FX currency, that exchange is very beneficial as the dollar's falling, but it also erodes purchasing power of Americans. But it is one way to keep companies and the stock market lit and inflation in play. We have to watch yields too. I know everyone's expecting big rate cuts and falling yields, and they're never going back up again. And I keep warning that this term premium that says, hey, why should we own your dollar? It's shite. So you've got yields that are going to have a very sticky premium on top of, to compensate for the risk of holding longer duration notes and bonds. So they're not going to fall precipitously like I think some want, unless we have a hard landing. So we've got lots more that we can.
What do you think of TLT, Samantha? We had the bull steepener, and then it's kind of flattened out a little bit. Do you think that that's just a temporary unwind?
That's definitely temporary. I think that my call from December of 2024 is that the 10-year, 2-year, and by the way, we were negative then, that we would go to 90 basis points. Now, I don't think we're going to hit it by end of year. That was my call. But I think we're definitely still going there. So for me, that 90 can turn into 100, can turn into 150. I think Gundlach all actually said 150 and I choked. So the long and the short of it is, the long end is not preferred for more than a trade. They might get a little bit of a bid because recession risk gets pulled forward. So be careful, know what you own and why. But as it relates to durable trade, dollar is shite, and so are treasuries. Unfortunately, gold is not. And I'm not a gold bug from years prior? Absolutely not. It is just simply the vehicle, the means of exchange that is happening in lieu of taking on foreign countries, taking on dollars and treasuries and oil. They're not. They're trading outside of petrodollar and oil. They don't need as much oil anymore, and they're getting it from other places. So they don't need the dollar. So that I've been talking about that. Foreign demand of US dollars peaked and is rolling over, but it's a slow boat. And treasuries, they stopped buying and they're selling a little bit. Japan is a vassal state, so they can't get rid of it. But basically, we still have a long road ahead. But I just wanted to kind of identify that for right now, I all of a sudden got bearish. And every single week I've been saying, I don't see much.
There's one great question. I know we're way over, Samantha, but Amplus Dev mentions, he says, is there less sense to hedge with near at the money at 6,000 rather than 5,000, considering it's either great or it's horrible? Well, that's a great question. And so I've been playing with that, actually, playing with the different scenarios because pricing is always changing. And the way that you can look at that is you're absolutely right. So either you pick a position that's going to be much more reactive to, say, a 5 or 6% sell-off or 7% sell-off, or you sort of tell yourself that, look, I'm not going to worry about a 6 to 10, 11% sell-off because occasionally they happen. They're not fun. They happen. It's part of life in markets, but it's going to be the unknown where things break a la 2008, a la these big selloffs.com where we do have a 50% sell-off or worse. And those are life-changing.
Yes,
those are life-changing.
But we're not there yet. I mean, if we get a serious pullback from 6,600 to 6,100, that likely 6,100 would get very, very strongly defended. We'd be in huge trouble if it didn't. And more to the point, we don't still have my corporate bond issuance data yet that's coming in end of September, which I think is going to kind of save the market. So let's just get through the next few weeks. Options expiration for the 19th, end of month. Let's revisit then. I wouldn't be going and doing 5,000 puts right here. That's not my intention of warning. That's not my intention of warning.
Right.
But I definitely think it's better to protect now than after we've pulled back a few hundred points and maybe very quickly. And if it does not get defended by the end of the month, you're already in.
Right. Okay, now let me just wrap up that thought. So the difference is, so the way that you can look at it is, okay, let's say your budget is $10,000 to protect to the downside. Let's say you can afford 2 puts. You can go down to the 5,000, use the same budget. So you're not going to look at it as, well, I can pay a lot less for the protection. You're going to say, well, my budget is 10,000, but now I can afford 4 or 5 puts. So now you have something that's not going to be as reactive, but is going to give you, this is a really, really lesser known second order Greek. It's called VAMA, and it's a terrible word. It sounds like vomiting, but it's probably appropriately named because what it measures is the sensitivity of vega, the rate of change in an option's vega to volatility changing itself. So basically it's saying when you have way out of the money puts, when the VIX goes from 20 to 60 or 80, you are seeing some serious VAMA playing into those way out of the monies, those puts that were like $2 and now they're $24. That is a kick up. That is the tail like flopping super, super high. So what you get with those way out of the money puts is something less reactive in a non-panic situation. But when there's actual panic, you're going to see those really, really explode higher because everyone is in a sheer panic. But that's really kind of super crash protection. So as I said, you have to kind of figure out what you're doing. If you're a trader, the 5,000 puts are not really going to be that helpful to you. If you're an investor, then it's different, right? So figure out who you are.
Okay. Hey, thanks everyone for staying late. Appreciate it. We'll see you next Wednesday. Have a great week and weekend. Okay, bye.
See you guys.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.